Most people believe they understand debt. They see it as a loan, a mortgage, a credit card balance, a monthly payment that eats into their paycheck. They view it as a necessary evil, a burden to be minimized and eliminated as quickly as possible. This is the personal finance version of debt, and it is a dangerous half-truth. If you view debt only through the lens of personal consumption, you do not understand money. You understand spending. You understand cash flow from a job. But you do not understand the financial system that actually creates and distributes wealth. The wealthy, the investors, the bankers, and the institutions that control capital do not see debt as a burden. They see debt as a tool, a weapon, and often the very substance from which money itself is conjured. To understand money is to understand that debt is not the opposite of wealth. Debt is the engine of wealth. Consider the difference between how an ordinary person uses debt and how a financial institution uses it. An ordinary person borrows to buy a car, a house, or to consolidate credit card balances. The debt is tied to consumption or to an asset that depreciates or simply sits there. The interest is a cost, a drain on future income. The wealthy person or the corporation borrows for a very different reason. They borrow to acquire assets that produce cash flow. They borrow to buy companies, real estate, or portfolios of securities. They borrow not because they lack money, but because they can use other people's money to amplify their returns. This is the fundamental distinction. Consumer debt is a cost. Productive debt is a force multiplier. When a private equity firm acquires a company, it typically finances 60 to 70% of the purchase price with debt. The firm puts up only a small sliver of its own equity, sometimes as little as 15 to 25%. The rest comes from banks, bondholders, and institutional lenders. The acquired company's own assets and future cash flows serve as collateral. The private equity firm takes control of a billion-dollar enterprise while risking only a fraction of that amount. This is not reckless. This is the architecture of modern finance. The first modern leveraged buyout of a public company, completed by KKR in May of 1979, illustrates this principle with almost surgical clarity. KKR acquired Howdell Industries, a manufacturer of automobile and aircraft equipment, for $355 million. The firm used $300 million in debt financing from a collection of banks and insurance companies. Out of the entire purchase price, only about $1 million came directly from KKR. $1 million controlled $355 million of industrial assets. This is leverage in its purest form. The debt did not weaken KKR. The debt empowered KKR. Over the next 6 years, Howdell generated an average annual return of more than 33% for KKR's investors. The debt was not a burden to be escaped. It was a structure to be managed, a claim on future cash flows that could be serviced and eventually refinanced or repaid from the very earnings the acquired company produced. This is how the wealthy think about debt. They do not ask, "How do I get out of debt?" They ask, "How do I use debt to acquire more assets, generate more cash flow, and pay less tax?" The tax dimension is critical and often invisible to the ordinary observer. Interest payments on debt are tax-deductible for corporations and in many cases for investors. When a private equity firm loads a company with debt, the interest payments reduce the company's taxable income. The government effectively subsidizes a portion of the borrowing cost. Meanwhile, the equity returns generated by the deal are taxed at preferential rates, if they are taxed at all before they are distributed. This is not a loophole. This is the system working exactly as designed. The tax code rewards leverage. It rewards the use of debt to finance investment. It penalizes income from labor, which is taxed at higher rates, and rewards income from capital, which is often structured to defer or minimize taxation. The ordinary person who works a job and pays down their mortgage is playing a completely different game from the investor who borrows to buy a company and deducts the interest. The scale of this debt-based system is staggering. Global debt, including borrowing by governments, businesses, and households, now totals well over $250 trillion. This is more than 3 times global gross domestic product. Debt is not a sideshow. Debt is the circulatory system of the global economy. Governments issue debt to finance spending. Central banks create money by purchasing government debt. Banks create money by making loans. In fact, banks create around 80% of the money in the economy as electronic deposits when they issue loans. Money is not printed and then lent. Money is created through the act of lending. Every time a bank approves a mortgage or a business loan, it types new numbers into a computer. Those numbers become deposits in the borrower's account. The borrower spends the money. The money circulates. The debt remains on the bank's balance sheet as an asset. This is the monetary reality that most people never see. Money is debt. Debt is money. They are the same thing viewed from different angles. The wealthy understand this at a visceral level. They do not fear debt, they manage it, they structure it. They use it to acquire assets that produce income, and they use the income to service the debt while keeping the equity appreciation for themselves. This is the playbook of every major private equity firm, every real estate developer, and every family office that has survived for generations. Family offices, the private investment vehicles of the ultra-wealthy, are increasingly institutional in how they use leverage. They build credit lines and war chests to seize opportunities when asset prices fall. They borrow against their portfolios to fund new investments without selling assets and triggering taxable events. They use debt as bridge financing to move from one strategic position to another. A Deutsche Bank study found that 61% of family offices regard leverage as either a strategic topic, directly affecting risk and return targets, or an important topic for risk and positioning. In Hong Kong, 3/4 of family offices consider leverage either strategic or important. These are not debt-averse institutions. These are institutions that have integrated debt into the very fabric of their wealth preservation and growth strategies. The contrast with ordinary household debt could not be more stark. Household debt is associated with higher inequality. Higher household debt levels are associated with higher income shares for the top 10% and lower income shares for the bottom 50%. Debt amplifies existing disparities because it is not equally accessible or equally structured. The wealthy borrow at lower rates against appreciating assets with tax-deductible interest. The ordinary household borrows at higher rates against depreciating assets or consumption with no tax benefit. The wealthy borrow to acquire cash-flowing assets. The ordinary household borrows to maintain consumption. The wealthy use debt to build equity. The ordinary household uses debt to finance a standard of living that their income alone cannot support. This is not a moral failing. It is a structural reality. The 1988 leveraged buyout of RJR Nabisco remains the most famous example of debt as a tool of conquest. The food and tobacco giant was auctioned off for $24.9 billion. Kohlberg Kravis Roberts, which won the bidding war against the company's own management, loaded the company with some $25 billion in debt. The transaction was financed with a combination of junk bond offerings and bank loans that burdened the company with interest payments of $9 million a day. $9 million every day. This was not a company that lacked cash flow. This was a company with $17 billion in annual revenue. The debt was enormous, but the cash flow was enormous as well. The new management team, installed by KKR, sold $5.4 billion in assets, focused on the core tobacco business, and began a cost reduction program. The company survived. The fears of wholesale layoffs and a breakup did not materialize. The debt was managed. The equity holders, KKR and its investors, reaped the rewards. The debt was not the end of the company. The debt was the means by which the company was acquired. This is the lesson that personal finance advice never teaches. Debt is not inherently dangerous. Unmanageable debt is dangerous. Debt that is structured without regard to cash flow is dangerous. Debt that is used to finance consumption rather than production is dangerous. But debt that is used to acquire assets that generate more cash flow than the cost of the debt is not dangerous. It is profitable. It is the fundamental mechanism by which wealth is created in a capitalist economy. The wealthy do not avoid debt, they master it. They understand the difference between a balance sheet that is over-leveraged and a balance sheet that is strategically levered. They understand that debt is not a moral failing. It is a financial instrument. It has no ethics. It has only a cost and a return. The financial crisis of 2008 was not a crisis of debt itself. It was a crisis of mispriced debt, of debt that was extended to borrowers who could not service it, of debt that was packaged into securities whose risks were misunderstood and misrated. The crisis was a failure of risk management, not a failure of the principle of leverage. The institutions that survived understood leverage. The institutions that failed did not. The distinction matters because it reveals that debt is not a simple good or evil. It is a force. Like any force, it can be harnessed or it can destroy. The wealthy harness it. The ordinary person fears it. And fear in finance is expensive. To understand money is to understand that debt is not the opposite of wealth. Debt is the raw material from which wealth is often constructed. The investor who borrows to buy a rental property, the private equity firm that borrows to buy a company, the government that borrows to build infrastructure, the central bank that creates money by purchasing bonds, all of these are operating within the same logical framework. Debt is a claim on future production. It is a way of bringing future value into the present. It is a way of accelerating growth, of acquiring assets before you have fully paid for them, of using other people's capital to build your own equity. The ordinary person sees debt as a monthly payment. The wealthy person sees debt as a balance sheet item, one side of an equation that also includes assets, cash flow, and equity. The wealthy person does not ask, "Can I afford this payment?" The wealthy person asks, "What is the return on this debt? What assets will this debt acquire? What cash flow will those assets generate? What is the net effect on my balance sheet?" The answer to those questions is the difference between financial security and financial struggle. The ordinary person who focuses only on income will always be limited by their labor. The person who focuses on assets and who understands how to use debt to acquire assets is no longer limited by their labor. They are limited only by their access to capital, their understanding of cash flow, and their ability to manage risk. This is why the wealthy get wealthier. They do not earn more. They own more, they control more assets, and they use debt to control those assets. The ordinary person earns income, pays taxes, spends what remains, and saves whatever is left. The wealthy person acquires assets, uses debt to finance the acquisition, deducts the interest, generates cash flow from the assets, and uses the cash flow to service the debt and acquire more assets. The ordinary person's balance sheet is dominated by a single asset, their home, and a single liability, their mortgage. The wealthy person's balance sheet is a complex web of assets and liabilities, each carefully structured, each generating returns, each managed for tax efficiency. This is not conspiracy. This is accounting. This is finance. This is the way the system actually works. The tax code, the banking system, the capital markets, the legal structures, all of them are designed to facilitate the use of debt for productive investment. They are not designed to facilitate consumer borrowing. They are not designed to make it easy for an ordinary person to borrow against their credit card to buy a television. They are designed to make it easy for a corporation to borrow billions to acquire a competitor, for a private equity firm to borrow billions to take a company private, for a real estate developer to borrow millions to build an apartment building. The system rewards productive debt. It punishes consumer debt. The ordinary person who does not understand this distinction is swimming against the current. The wealthy person who understands it is swimming with the current. The current is powerful. It moves trillions of dollars every day. It does not care about your feelings about debt. It does not care about your desire to be debt-free. It rewards those who understand it and punishes those who do not. The ultimate insight is this: money is not a thing. Money is a claim. It is a claim on goods, services, and future production. Debt is also a claim. It is a claim on future income, future assets, future cash flow. When you understand that money and debt are both claims, you understand that they are not opposites. They are different forms of the same underlying reality. The financial system is a vast machine for creating, allocating, and enforcing claims. The wealthy are the ones who understand how to create claims, how to allocate them, and how to enforce them. The ordinary person is the one who merely accepts the claims that others create. To understand money is to understand that you are either a creator of claims or a bearer of them. You are either structuring debt or servicing it. You are either acquiring assets or consuming them. There is no neutral ground. There is only the choice to understand the system or to be controlled by it. The choice is yours. But the system does not wait.